Yeah, welcome everybody. This is going to be a meaty one. I'm excited about this. Yeah, let's jump right in and let's do this. Shubes, any introductory remarks you want to make before we begin?
I'm very excited to be present in this call today. Now that we are all here, let's get started.
All right, let's do this. Okay, so I think first thing that we wanted to talk about was a sort of little realistic view of where we think the world is in our particular category of deepen. I think the last 3 to 6 months have been incredibly instructive for a lot of projects and the ecosystem. Uh, we have met every single founder and investor and etc. that we could. In fact, you would have seen us, or me specifically, missing in a lot of our spaces weekly simply because travel and calls to meet with other people. And what the broad consensus seems to be, and I'm not implying any moral judgment or anything on this, the idea here is just to sort of look at things with a clear eye. Um, Mass retail hasn't embraced Deepin as well, by and large. I think that's fairly clear. I think a lot of projects did buybacks from market, Helium notably, and the impact maybe leans one way or the other, but at least we can all agree on the impact is unclear. It depends on, did you do it long enough? Did you do enough? What sector are you in? Things along those lines. So it's been unclear. Everything that we've heard from exchanges and market makers and everybody who's launched projects is there isn't that much trading volume from retail, general people in North America and Europe. Most of the volume that a lot of projects and exchanges and people are seeing, and what they're focused on at least, seems to be people out of Asia, maybe China trading. And these are traders. They want something volatile. They don't care about the underlying project. It's about playing the volatility game. It also sucked. I think we note that Demo, I think their co-founders step aside, and that kind of sucks because Demo had, was a really good project and one of the early ones as well. And along with that, while there may have been one or two goodish examples that people can point to, there really haven't been enough winners to inspire a broader market. So that is what hasn't worked, right? What might work going forward, and of course, this will require other things as well, adaptation among other things too, will be markets start to value projects rationally at some point. And you've got to keep grinding and prove numbers and do the right thing, and eventually you will be rewarded. Once market starts to warm up, then of course traditional institutions, liquid funds, things along those lines will fall in love with Deepin again because the reception to Deepin is not as good as it could be at the moment among all of these folks. I think why this matters is that this is nothing like the way the market was when Deepin was sort of really getting off the ground and the flywheel was you show good numbers, the market rewards you with a reasonable value for the token, and more people are incentivized to buy into the network, and you get that virtuous circle, and you kick off revenue, and so on and so forth. It seems like the market wants more from the sector than just that model. So those things now have to be explored, created, invented, and made happen if you really want to succeed. The previous way of launching a token, which was heavily market the project, get listed on the best exchanges possible, and hype it up to the moon and go for it, right? That doesn't exist anymore as a viable strategy. Pretty much everybody that you talk to seems to have a reasonable consensus on that. Yeah, so that's where we see things at the moment. Tubes, do you have anything to add here, or should I continue?
Another key point that we learned on the way is the centralized exchange that I think we're covering in the next slide. I should hold off to that. But yeah, let's continue. Let's not mix two different things. It will be confusing then. Yeah.
Okie dokie. So we're proud of and thankful, and it's because of the community and all of us that these are the numbers we've been able to hit pre-TG, pre-launching a token. And I think all of us should be proud of the fact that we've done this with a fraction of the money raised by most other deepen projects, right? So everybody knows these numbers. We've got about 120,000 or so hotspots deployed, tons of daily active users, thousands of terabytes of data being consumed, monthly revenue growing really healthily, pin codes, regions, slow geographic coverage is picking up dramatically, and we've got an unbelievably healthy, close to 25,000 hotspots almost sold. Right, we're already the largest deepen by actual data being transferred. We're second and getting close to in fiat revenue among all deepens. We anticipate 20% month-on-month healthy growth this year. Our fundamentals are great. Revenue from real broadband demand, not, whatever, all of you know that really well. And we think from an on-ground perspective, we've shown that the market has demand and our ability to scale and to meet that demand. So we think if you look at it from pre-token launch, what are you supposed to do? Hit the best numbers that you can, prove that demand exists, and then hopefully the market rewards you for that. I think we're happy to say that we have a very strong MVP and proof that, yes, this market exists and this can be done. So this is where things get interesting. So we've been talking to exchanges for months and talking to founders and everything that I've said. And this is a framework of how we've thought about what the best way to launch is. And we want to walk you through that. We want to show you what we were thinking, how we were thinking, what the trade-offs are, and then explain why we think this particular choice is the best path forward. So option A, and I think this is what 6 to 8 months ago was common wisdom, and when we first started talking exchanges and the rest of that, is again, you go get tier 1, tier 2 exchanges. The idea is you get tier 1, tier 2 exchanges, ideally the top tier 1s, and then you launch on a SEX and a DEX. You do it with the maximum amount of hype that you can. And then, retail and broader players kick in, and it goes from there. You get a high amount of volatility, which is great for traders. You get tons of retail people, all of that, right? And a high amount of visibility. Now, what we've learned while talking to all of the exchanges, and we have negotiated the best deals possible, is that launching on the tier 1 exchanges will take anywhere between 3 to 8% of total token supply. And we'll also have to bridge a certain number of tokens to the SEX's chain, depending on which ones we finalize on. The second thing that all exchanges have told us, because again, Deepin is not that hot, and they want to incentivize as many of their users first for price discovery and that sort of thing, is all day one unlocks that would have been there. And for example, and including the Genesis supply, the Genesis tokens that would normally be vesting from day one, those would have to be locked for 180 days, 6 months after from the date of TGE. The tier 1 exchanges also require significant stablecoin deposits as well, and it's a fair chunk. It halves the runway of the team and our ability to do things over a longer term. Now, that isn't to say that this is some bad deal or something like that. No, the 3 to 8% that we're talking about is across multiple exchanges. And once we get feedback and that sort of thing, we can describe that a little bit better. But we've got really good deals. If this was a bull market, this is how you would want to do this thing. The second option is a really interesting strategy that's coming up. A lot of the founders that we have spoken to, they've said, and these are people that have listed on the tier 1 exchanges and gone through this. A lot of them have said the volatility wasn't worth it. They gave up a lot of the tokens. You basically have tons of sharks and traders having fun with your token, and then it just dies. And so what they found is rather than the top tier exchanges, the long tail of like literally, the bottom 100 exchanges, the small ones across the world, serving niche markets in specific countries and that sort of thing, they provide a lot of floor support because those users tend to care about the underlying project and they tend to buy and hold longer. So one of the strategies that we're seeing people try out, and I think we'll see more and more of the time over time, and we think building the ladder and building that momentum and then listing on the tier one exchange would actually be a better way of doing things. So the idea is that you would launch on a DEX first, and then you would start launching in succession of small exchanges and a lot of them. This is much more capital efficient, both on the amount of tokens that would be given to exchanges and on the stable coins that would be used, and the fact that there wouldn't be any aggressive lock-ins for existing token holders and the community, because these are smaller exchanges. You're bringing a great project, you're building momentum, volume, and everything as you go. And they're incentivized to push you more because you're something new and useful to their audience and that sort of thing. So we think that this approach is pretty good because it provides what would be core to deepen if your thesis is that you should continue to grind, continue to deliver, and the market will reward your metrics and value you correctly, while of course you innovate and change narrative and shape and do all of the things that you have to do. The third approach would be a more hermit-like approach, would be just, like a DEX basically, and that's it. And you wouldn't do a centralized exchange listing at all. The foundation would provide a liquidity pool. There'd be no lock-in for the community at all. But the upside of this extreme approach is the maximum amount of capital that we have would be deployed towards growing the network and growing the metrics and growing the business, not be given to exchanges. So, Shubs, anything you want to add over here? Broadly speaking, from a Goldilocks perspective, we think choice B is the best choice. And we'll dive into the details of all of this as we go forward.
Yeah, just to mention, to add to that, the core difference remains between B and C is in B, we actively pursue smaller sexes. In C, we wait for exchanges to reach out to us, centralized exchanges, and opportunistically, opt to list with them wherever we feel deemed fit without paying them anything in terms of tokens or stables. So that's the core difference between B and C approach. Of course, A also requires us to move a significant supply of our token away from Solana and on their native chains. That is the key requirement that comes along with tier one exchanges. Otherwise, yeah, pretty much you have covered. Yeah.
Yeah. I think a great way to think about this breakdown, and we'll do this in a little more detail now. So this is a broad view of the token allocation and supply. You can see that there's a max supply of 10 billion tokens, 4.84 of which will be pre-mint and locked, and we'll walk you through the detail of that. And the epoch emissions over time would be 5.16 billion. Now, the key stakeholders that currently hold tokens and would be assigned tokens, depending on option A, B, or C, I'll walk you through that in detail now. So the seed investors, these are the first investors in Dabba. They hold equity and token warrants. They constitute 8.46% of total supply. We also did a private pre-sale of tokens as well, and this constitutes 2.95% of supply. If we were to go to option, so the amount of tokens that have been allocated towards exchanges right now stands at about 7.3%. And I'll show you the breakdown of how those tokens get used across. The foundation holds 6% of tokens. The team holds 15% of tokens. The community Genesis pool, which is the Genesis rewards that everybody is getting up to TG, constitutes 8.4%, and emission rewards are 51.6% as well. Okay, so in option A, basically what the net outcome ends up being is you have 8% of supply available on day one. And the way that breakdown works is if we listed with tier one top exchanges and push this hard, all seed investors are locked anyway for 2 years, and then a 2-year vesting period after that. Private pre-sale will also be locked. The exchanges will get 7% spread across the exchanges. The foundation would have 1% unlocked on day one. The team, of course, again has a 2-year unlock and 2-year vesting. So nothing where that would be completely locked. And community genesis tokens would have to be locked as well. And emissions, of course, would continue as daily, but since it's day one, that would be nothing. So you can see that you get basically about 8%. And the idea on a timeline, which we'll come to in a minute, but we are committed to launching the token in Q1 by the end of this month, as committed to earlier. Option number 2, you can see is we believe in the current market, the more measured approach to take. So seed investors, again, locked for 2 years. For the private pre-sale of the token, 10% of theirs would unlock. So that would be 0.2% because they hold 2.95%. Exchanges over time, and this would be split across as many exchanges as possible, you would give up about 2%, but that would be staggered over a period that I'll talk about in a little bit. Foundation would also unlock 1% on day one because Foundation needs some tokens. Team, again, everything is locked. Community Genesis tokens would unlock as per normal schedule, roughly at the rate of 0.1% tokens per day, per epoch. And emission rewards are less than that, so it would kick in on day 2 onwards, and that would continue as normal. So basically, in the sort of middle ground approach where you're going for a DEX and then small sexes and as many of them as possible, roughly over a 2-quarter period, roughly over 6 months, you would have a supply of 1.3 to 3.3%. And the idea behind this is we would do the DEX launch immediately within the month of March, and we would slowly do sexes one by one in Q2 and Q3 over the course of this year. Option number C, DEX only. This is the sort of, I guess, extreme-ish version. Seed investors, again, are fully locked for 2 years. Private pre-sale, again, 10% gets unlocked on day one. Nothing would be given to exchanges, of course. Foundation, 1% would unlock. Team, nothing unlocks. You get 0.1% again for community genesis because that's the normal thing. Emission rewards would continue from day one, end of day one onwards, and you've got a total of 1.4%, and we would kick this off by this quarter, by the end of the month. So you can see one way or the other, we are committed to launching the token. We believe, and of course, open to discussion. The whole idea is to talk about it and do it. But we believe that the Goldilocks middle one is the best way to go because we think that in this given market, it provides the best breakdown of things. Tubes, anything you want to say here?
I think summarized pretty well. Only thing that I want to highlight is the exchange contracts from the tier ones are in place. So if, as a community, the feedback that we receive in the next couple of days is that we want to be going with tier one, definitely we can go with that. And that would mean we are launching on, it comes with its own pros and cons. So comes with the option B and C. B is a very balanced approach, given the kind of capital that we have put together, the kind of growth we are seeing in the last 2 quarters back to back.
Well, I think there was a power switch at the office.
Yeah. Let's know if you can hear us.
The guys are on a network that doesn't have a UPS on it.
Yeah, we lost power in the building.
Yeah, we're back. Nice.
Sorry about that, everyone. The joys of now summer kicking in Bangalore.
Yeah, so I was saying tier one exchanges are in place. If we were to go ahead with option A, with the feedback coming in from community, we will be able to do so within March this year, which is Q1. Tiered option B, which is start with DEX and then go with the sexes in the next quarter or two, is the more balanced approach given the kind of capital we have raised and to meet our commitment towards the growth that we want to achieve in the network growth. So option B is the most feasible one, and see how the market reacts, and if we are really delivering in terms of number that we have been able to deliver in the last 2 quarters, we might get interest from tier one exchanges also, but that is something very unlikely because once the price discovery happens at tier two exchanges, it's very rare that tier one exchanges come back and they are interested to list you because they would have lost the initial, the token drops that they would have got, plus all the other things they can do along when they're launching it on their platform first. So that is, as a community, we need to take that decision that are we okay to not be interested for tier one exchanges
I mean, if you're
anytime
doing
soon.
really well, they'll still list you, right?
Yeah, of course. Yeah,
It's not
that is
like it
true.
doesn't
But
happen.
no, I'm not saying it doesn't happen, but in all being open and honest over here, we are not one of those projects who have raised $100+ million of dollars that, we have that sort of backing. I'm just trying to be realistic over here in terms of the possibilities. So setting expectations right, that's all. Yeah.
No, fair enough. You're right. We should approach this with clear eyes and clear mind and understand what the trade-offs are. Awesome, awesome. Okie dokie, next one. Okay. The other thing I think a lot of people wanted clarity for is the unlock for the foundation. It would happen roughly over a 2-year period. You'll note that here it says 11%, whereas in the earlier slide it says 6% here. Basically, if we go with option B, which we would like to, and we think that that would be the correct option to go for, any of the supply that is not used to be given to an exchange would come to the foundation. So we're assuming that 2% ends up going to exchanges and the remaining 5% or so should come to the foundation. And that's why over here it says 11% and not 6%. So yeah, foundation will unlock roughly over 2 years. Okay, so that's it on the sort of choices. I'm sure a lot of you have a lot of questions right now already. I can't see the chat, but I'm assuming there are many questions already. So before we get to that, we just wanted to go over the rock solid basics foundation of the tokenomics, because what we're saying now is, yes, we're ready to launch. This is the way that we think we should launch, and we just want to kick off and start executing it. So a refresher on the foundation and the core thing, because we've grown so quickly. It's worth revisiting what the tokenomics design means in the context of this massive growth that we've had and at the time of launch. Okay, so the first thing to note is how tokens sort of flow per epoch. This has barely changed at all. So basically, out of 100 tokens, 25% goes to the LCO, 12% will go to the bandwidth provider, 60% will go to the hotspot owner, 1% to the hardware maker, and 2% to the location owner. One of the things I don't think we've had a chance to explain that we wanted to show over here is how the actual fiat money flows through the protocol as well, right? So for every dollar of revenue, where does it go and what happens to that? So 45% of it goes towards buying back the tokens that LCOs get, and those tokens are bought and burned. And this is because at the beginning, at this growth stage of the network, the LCOs and the bandwidth providers require fiat in order to pay actual alterations and that sort of thing. Their transition to mostly being compensated with tokens is going to take a little while. So it's going to be largely fiat at the beginning, and then it fully moves to tokens later. So 45% goes to LCOs, 30% goes to bandwidth providers. Those tokens are acquired and burned. 5% of that revenue will be used to support hotspot owner liquidity pool. So those tokens are bought, not burned. And 20% of fiat revenue goes to Dabba Inc. operations because we also have a ton of costs that are in actual fiat at the moment. But what you can see from this is 75% of all fiat revenue is committed to buying back DBT from operators at the core build out stage of the protocol. So that's how tokens flow through. This is how a dollar flows through. Now, just to clarify this in a better manner, Shubs, do you want to talk about this slide? Because this sort of defines
Sure.
how value
Yeah.
gets accrued to the token and that sort of thing.
Sure, I'll take that. So the total revenue in terms of, I'll explain in terms of percentage first, and then we can go down with a dollar example as well. So if you look at the breakup right now, 37% of the community pool share at each epoch goes to two providers, which is the LCO and the bandwidth provider. Dabba aggregates the bandwidth provider, but eventually these 12% of bandwidth shared tokens goes to the actual bandwidth provider, which are the pipe operators. So as a Dabba, we operate where we do a contract with all these different pipe operators and tell them, we aggregate this and tell them deliver the specific pipes to our partner location at the LCO locations. And in turn, they are paid through us, which gives them a sense of timely payment schedule, turn giving us a better pricing in comparison to a direct LCO provider. So we are able to bring in the economy of scale, getting a better negotiated rate for bandwidths. So that's how the bandwidth delivery works. Now, talking about the token terms, 25% of the token share in the epoch goes to the LCO and 12% goes to the bandwidth provider. This constitutes a total of 37%. Now, these two providers currently do their business in fiat only, which means that in order to run their operations, their margins plus everything else, whether it's taxes, whether it's their, the manpower, everything has to be paid in fiat revenue. So as a protocol, what we are doing over here is we have a minimum buy commitment from them, irrespective of the token price. 45% of share needs to be paid to the LCO of the revenue generated at the hotspot level to the LCO. So what it means is 25% of the token shares that he's getting would be bought from him at a minimum of 45% of the revenue. So if $100 is generated, $45 of that has to be given for 25% of token, irrespective of the token price. If the total token denominates more than 45% as well, still the entire share of those tokens will be taken, but committed 45% of the revenue will be shared with them. Same applies with the bandwidth provider. So now, if you look at the dollar value, total of 45% is for the LCOs and 30% is for the bandwidth provider. So a total of 75% of their revenue goes into these two players in order to honor this commitment to run the operations. So for every dollar generated, 75 cents is being shared with these two operators. Can you go to the next slide, Karam? I mean the previous one then, yeah. So 45% has been given to the LCO, 30% has been given to the bandwidth provider, and their tokens are acquired and burned. So 37% of the tokens from these two operators are getting burnt at every epoch level. The 5% of the fiat revenue has been put into a LP pool, which is essentially a pool every month created from the fiat revenue that we are generating in order to buy tokens from whitelisted wallets that are owned by the hotspot owner. So this liquidity pool is being created. This over a period of time will grow as our revenue per hotspot grows, and we will be able to support that. But minimum commitment to start with is 5%. 20%, as Karam explained, is kept with Dabba to honor its commitment, whether it's the taxations, salaries, and running operating costs. So this is the breakup of the dollar level, how it is spent and in which parts. So to start with, at protocol level, 37% of the tokens from the hotspot LCO operator and the bandwidth provider would be bought back and burned. This is the definition of our buyback and burn. We are not buying from the open market. We are not buying the DBT from the open market to start with. This is where the revenue flows in. 5% is reserved today, which as our revenue grows, the margin increases. We have a solid plan for increasing the revenue per hotspot. We will talk about that. To start with, that pool starts at 5% of the revenue, and eventually this will grow. And 20% is kept for running the operations at Wi-Fi Dabba Inc. That's where we are today.
Huh. So on a realistic level, like you can look at this is where the current network is, right? We've got 120K hotspots. We're roughly at about $7 a month in ARPU. So we're roughly making about 850K or so. Now, how is this 840K broken down, right? So 630,000 of that, which is 75% of the revenue, the total revenue that we make, goes to the LCOs and the bandwidth providers. As we go forward, of this revenue, 5% of which would be used in a liquidity pool, right? And the remaining 20% of which would be used for Dabba ops and to run the actual Inc. and company and that sort of thing. And just a note, if you think that this is a lot of money, it's really not. We're using a lot of equity money as well. That's not even listed in this breakdown, right? But this gives you how money, the revenue that is earned, how it is currently being used, and how it is going to be used at the time of TGE. Yeah. So, okay, that covers how we're doing revenue buybacks. And now let's just talk about how per epoch DBT distribution occurs. Okay, so
Yeah, I can talk about that.
Oh.
Yeah.
Sorry.
Oh, you want to go ahead? Go.
No, I got a lag here. Do you want to talk about this or am I?
Sure. So at each epoch level, the distribution happens, which is among the community owners, which is your hotspot owner, then the LCO, then the bandwidth provider, the location owner, and the last in line, the hardware provider. So if you look at the current stats, we have 125,000 deployed, of which we have sold 25,000 of hotspots, and 100K remains unsold. The total rewards are approximately 1.6 million of tokens every day, out of which 320K is going to the sold hotspot, and the remaining 1.28 million are being awarded to the unsold hotspot rewards. Out of these 320K rewards that are being given to the 25,000 hotspot owners, they get to keep 60%, and the remainder of the 40% goes to the LCOs, the bandwidth provider, and the other two operators into the ecosystem. The same happens from the 1.28 million share, which is 40% of those tokens go directly in the wallets of LCOs and the bandwidth provider, the location owners, and of course the hardware provider. So if you look at the breakdown of numbers, 760K, 8K roughly are available with the pool, which is going to be maintained by a foundation called as incentive pool. This pool would be essentially used for supporting the future Genesis reward, because Genesis rewards now stops. So we're going to incentivize using this pool. 70% of these rewards would be used for incentivizing once we open up sales post TGE. Essentially, the rewards along with the when somebody buys, they would be rewarded for owning a hotspot. Of course, these tokens will come with a lock schedule. And the 30% of this share would be used for the staking rewards. We'll talk about the staking, the mechanism in the next slide. But this is the pool where we will be supporting the staking pool and the Genesis reward, equivalent of the Genesis reward.
Yeah, so I just want to explain the philosophy behind this, right? It's that we are always going to try to maintain more hotspots on the network than ones that have been sold, right? Because the idea is as human growth is everything, right? So as humanly fast as possible, onboard as many LCOs as you can. So this will always be ahead. We also recognize, however, that means that if you own a hotspot, if you have 1 million hotspots out there, and only let's say 50,000 or 100,000 sold at that point, you're getting like half a token or one token or something like that, and that's incredibly unfair. But the bandwidth share and the LCO share should be given to that LCO and that bandwidth provider that has been onboarded because they're paying for the bandwidth and they're paying for the revenue and they're bringing their network and their customers and their growth, everything onto the network. The remaining 60% of which should go back to the community, right? All of the not unsold hotspots, the tokens that they earn. So we're really clear on, we think the best way at this moment to structure all of those tokens and reshare them with the community is 30% of it should go into the staking pool because that serves the existing community, and 70% should go into incentivizing new people to buy hotspots and further things for the community as well. Because we need a mechanism, because the whole point is as many people as possible need to buy hotspots in order for the network to grow and more revenue to be generated and more value to be accrued, right? So bringing more people and giving them reasons to buy hotspots is a very important thing. And ultimately, it's going back to community, right? Not only should existing community be rewarded, but you need to bring in new community as well. So that's the broad thinking behind this one. Ultimately, the community is getting all of the rewards. It's just taking a slightly circuitous route. If anyone has suggestions on a cleaner structure, we're down to think about that. Okay. So obviously at launch, we're going to have a staking mechanism in place. Shubes, do you want to cover staking?
Sure. So a very straightforward, simple staking mechanism to start with. There is no minimum requirement. You could lock in your existing, or you could buy from the market and stake them. As defined in the pool, 30% of the daily epoch rewards of the unsold inventory would be marked for everyday epoch level. There will be two buckets, either lock for 6 months or 12 months. The maximum stake is unlimited, so you could stake as low as for the daily epoch, or your Genesis auto lock them as per the unlock schedule. It would be a pro rata distribution. So if there is for that specific day when the rewards have to be calculated, the total pool available is 30%, and the total the lock pool is a very significantly low number, then one could get a very high return in terms of daily reward. So it's going to be a dynamic reward. So it will essentially depend upon what is the total staked pool divided by the number of the total pool size multiplied and into 30% of the stake size. This would give you a daily reward calculation. I'll be putting together a simple Excel to calculate your rewards you could play with. We intend to publish the entire updated tokenomics together. There would be a section along with it where you could put in the number and play around with the reward structure in terms of what to expect in terms of staking rewards. So it's going to be simple. We are not complicating things. We had a bunch of other ideas, but to start with a simple staking mechanism, you could lock your existing daily rewards that you're generating. Genesis can be locked, and you could claim from the pool reward.
Yeah. Awesome. Thanks for that. Yeah, so that's the sort of quick overview of where we stand. We're really excited. Yes, it's going to be a rough 12 months. I think that's for the entire planet in every part and way possible for everyone. Eyes focused on the mission. We think we have to innovate in the way that we do the launch, adapt to new narratives, focus on growth, and find a way, because we have solid core metrics, and we've just got to take the time to be strong and showcase those metrics to the market. And we're confident that the market should deliver. So we think there should be a really short, sort of feedback period of a couple of days or something to get a sense of what everyone thinks about this. To be clear, our choice is choice B. And we also think that given this, we don't believe that the Genesis liquidity pool is possible. To raise a significant amount, because the idea was to raise a war chest for the foundation as well, and then share that with the community. In this particular market, given the way that people are thinking about deepen, from what we can see, you could do a half-assed one, but we don't think it's genuinely, we don't believe it's viable at this moment in time. We're having discussions. If something changes about that, we'll definitely let you know. So yeah, that's where we are. I imagine people would want this slide up while we go through questions. And yeah, whoops. Let me stop screen share. I got signed out from Google there for a sec. Okay, do you guys want to deal with the little questions, whatever, while I bring my this thing back?
Yeah. We got one from PS350 here. He would like to understand, I mean, his question directly is still not getting the answer to what the utility of DBT and who wants to buy the hotspot owner's share of DBT except for market speculation. Doesn't look like there's structural demand / buy side for HODBT. So I think he's looking for a breakdown of the utility and what's going to drive the demand for the token.
Yeah.
I can start with the.
Go for it.
So there are two clear things. First is the LP pool at the DEX level that Dabba Foundation is going to start off with, which is essentially to start off with a 5% pool of the fiat revenue that is being generated. That is going to, as I mentioned earlier, is going to increase over time in terms of as the revenue per hotspot goes up. To give you a sense of understanding, each of our hotspot hardware is now capable of running the CloudBot stuff that has been going around. So we have been deploying a bunch of locations to experiment with. As we deploy at scale, the revenue per hotspot is going to increase. The increased revenue will directly result in giving the margin up, because at the fundamental level, the revenue that we have with the LCOs and the bandwidth remains constant. It's not going to increase in terms of it. So from here onwards, the revenue that gets increased, it's going to directly relate to increasing the share for the hotspot owners to buy back one. Second utility, the core utility that comes in when we launch, when we open up our hotspot sales program again, one would be able to buy at a much attractive price using the DBT itself, whether it's the directly owned by the hotspot owner. If they want to reinvest their the tokens DBT over there, they'll be able to buy at a much better price than somebody was to pay with the fiat. And third, of course, as we open up the other dev platforms on top of it, all the utilities in terms of using the services would be in DBT. Again, that DBT demand comes into the picture. Karam, you would like to add anything over there?
Yeah, I'd like to just sort of reiterate very clearly that the core utility is to buy bandwidth. That's what the token exists for. The more customers we have, the more revenue we generate, the more bandwidth, the more tokens we buy, and the more tokens we burn. This is a flywheel that takes a little time to get started. The reason we have started with a lower percentage of how much revenue should be given to supporting a pool or buying and burning tokens is because there have been multiple deepen projects that have tried buying back from the open market and other strategies in tens and millions of dollars over the last couple of months. And right now, there's not a direct correlation with the more money you spend to buy back and burn, the more the market is going to reward and value the token. So from that perspective, given that the focus is the growth of the network, we believe that initially revenue should go towards building out the network and onboarding LCOs as much as possible, but setting a floor that, yes, we commit to 5% is going towards this, and that's going to consistently increase over time. We're not aiming for gimmicky utility of do this and do that. The core utility is this is a token that represents bandwidth purchase. The stakeholders represent the proof of physical work that bandwidth was delivered to that customer. So we'd like to stay clear and true to that. It's tempting in a bear market or as a sign of desperation to say, look, here's 100 things. Hey, trader, buy this token and you can swap it for this and do that. Like, no. The clear long-term utility product.
Great answer there. Used for services, used for hotspots. Yeah, you covered basically, not a whole smorgasbord of things that we need to be using this utility token for. But yeah, for paying for services, at the end of the day, we're buying bandwidth with it.
There's another question we have from Kelvin Podolsky. Does Dabba loot boxes sales token release on TGE day, or when's the release for that, for the Dabba loot boxes?
Yeah, they will release their super tiny percentage point of the total supply. So don't worry about that. It's in the 0.00 bucket percent of total supply. We'll give out that release schedule really soon. If there's any concern of the loot boxes impact anything, they're not even a rounding error at this point.
Ulendez asked an example of how the process would work if hotspots are not sold for a determined time and then someone buys a hotspot and gives the actual numbers being divided. I didn't quite understand his question. I'm gonna jump into it a little more, but earlier he actually asked something very straightforward. Are we looking at the same dynamics for the vault system going forward here as what we've already experienced and expected in the past?
No, the vault system is not. We're not going to do a vault system because that was fundamentally going to be part of the Genesis liquidity program. At that point, 6 or so months ago, or slightly more than that, when we announced it, the market conditions were very different. There was a degree of enthusiasm for launchpads and vaults and deepens doing that. We don't believe from the feedback that we've gotten to everyone that we've spoken to that you could do a significantly sized vault in these market conditions. So unfortunately, it does not seem like the Genesis liquidity pool and the vault concept will be applied here. We're not going to go ahead with that as of now. It sucks, but yeah.
I can only imagine a follow-up question is then for those people who invested in that vault process in the beginning, what would those people, what should they expect going forward?
Yeah, we're going to have a process by which we give them the tokens back or give them an option to purchase hotspots. Shubes, do you want to cover this?
I don't understand the question.
So just to clarify, what is going for is the loot boxes. So we're not having a vault launch, but we did have like people buying in the loot boxes.
What I meant, yeah, so like people who purchase DBT in the beginning, they'll just be getting a DBT allocation, but we are not like they're still going to get the same DBT allocation at the structured price, whatever they had from the loot campaign. Basically, is what I'm trying to establish.
Yeah,
exactly.
if they have purchased if they have purchased into the loot box at whatever the price of, I'm not sure if the price was disclosed over there, but whatever the commitments have been made in terms of the loot box campaign, they'll be honored. Yeah.
Yeah, I mean, our goal is to make happy anybody that was disappointed by that, because again, just to clarify, it represents a very small percentage, and it was a bump from on the road in an earlier time of planning when conditions were different in the market. Our goal is to support the community and do the correct thing.
It looks like there's a lot of people typing out questions. I think it's also important to note that this is kind of the first of tokenomics discussions. We are planning on having more discussions around tokenomics, as we're getting feedback. So as Karan pointed out, we will be having, making sure the community can give their feedback over the next couple of days. And we're always looking at feedback from the community. I think, as you guys can see from this call and every call that we've had, we like to address everyone's concerns. We make sure we capture everyone's concerns and their thoughts and address it to what's best for the network and what's best for everybody here. So yes, keep the questions coming. I can see new questions being added. But to summarize, we will be having more town halls in the coming weeks as we lead to TG to cover more aspects of tokenomics and also answer questions that you guys have. So there is enough time for review, for feedback. So you guys don't have to worry about that.
So going back, Andrews had asked a question early on. What would be the runway for Dabba Inc. with a tier 1 exchange listing versus without one?
So we have sufficient runway for the next 12 months in terms of where we stand and to build out our network at the 20% month-on-month growth we are seeing. As we open up the sales of the hotspot and we are able to match the same ratio that we have been able to, which is anywhere between 20 to 25% of the network that we are deploying, and we are able to sell that network in terms of the people who acquire the hotspot, we'll be able to maintain that. If that number drops, we don't see a similar ratio being able to maintain. The runway reduces, which means that instead of 12 months, we'll be shorting that runway. If we were to go down with the tier one exchanges, we would be starting off with half in that runway, which is we'll have sufficient funds to keep building for the next 6 months. In that period, we have to either raise more equity or we have to bump our hotspot sales significantly. So that's the trade-off.
All right. Elandalus had a question where can you give an example of how the process would work if hotspots are not sold for a determined time and then someone buys that hotspot? Like, give the numbers being divided, how will that work? If to the unclaimed collection there are DBT that is being associated to the unclaimed hotspots when they get bought.
So this is going to be a dynamic pool where every day the epoch that is generating tokens, the sold hotspot, the hotspots which are owned by hotspot owners, those tokens are given out to them. The denominator for arriving at the number of tokens that the hotspot owner receives is going to be the total deployed hotspots. So to be clear, in terms of example, the current stats are 120,000 deployed and 25,000 being sold. So in this case, each hotspot is receiving 1.6 million, which is the approximate number of epoch emissions, divided by 120,000. So this is the number of tokens that the hotspot owner receives. From these tokens, a 40% share is being given out to the four other participants, the LCO, the bandwidth provider, the other two players. Then the remainder of the tokens are held by the foundation under the incentive pool. From this pool, we essentially use this for rewarding the new purchases. This is going to be a dynamic allocation to match supply and demand. If we see that hotspot sales are slowing down, we might bump up the number of rewards depending upon how much this pool has. If the hotspot sales are consistent, averaged out of rewards would be used to incentivize new buyers. And the same portion from this token, this incentive pool, a 30% pool would be kept aside to reward the staking mechanism that we have starting with. So to answer the question, it's going to be a dynamic allocation in terms of the new purchases, depending upon how many tokens this pool has and what sort of demand we are seeing in terms of new hotspots being getting sold.
Yeah, and I want to add to that. This is the year to be innovative and try new things and new ways of doing things, because it's going to be a rough year for everybody. We've got to continue to build market trust, continue to build sales and things along those lines. So that's why we're not saying each hotspot immediately from the unsold within 10 days, if not sold, gets X or Y or that sort of thing. We're going to continually keep trying a basket of things.
I see one question here saying, is it necessary for there to be a lockup for option A? Is that usually required by centralized exchanges?
Yes, that is non-negotiating terms of conditions if we have to go with tier one exchanges, which essentially the requirement is they want to control the supply in terms of the available unlock on day one rather than the first few months. Uh, you'll be surprised, like we were surprised, it was a 12-month minimum lock-in, which was being negotiated to half. But beyond that, they were unwilling to move on that. And both the pre-sale that we did plus the Genesis, both will have to be moved for a minimum of 6 months cliff before the vesting starts. So, yeah.
Okay, that clears up a lot of the option one questions, I think.
They wanted an arm and a leg, and we managed to negotiate for just the arm.
Okay, so Andrews had a question, which was how many hotspots does Dabba Inc. own versus the community allocation?
Dabba Inc. does not own hotspots. Foundation owns. The percentage of hotspots owned by the team at Dabba Inc. is roughly around 150 devices. I'm not sure about the exact number, but it is certainly less than 200 devices in total. Foundation would be the custodial arm that would be holding all the unsold inventory before they are being sold to the hotspot owner by paying either fiat or stables or a DBT.
Yeah, I think there's a little bit of sorry, just speaking to the chat, I've seen some back and forth on the vault and GLP. I just want to make it clear, just like the guy said earlier, contributions to the vault, those will be honored. The mystery passes, basically that entire campaign that we ran, those will still be honored. That is not the GLP. That the GLP is different than that. And I think over here, something to keep in mind is, the idea is to make sure that, we're launching with the best intentions for the network and everyone who's participating in it. So I think, like the guy said, we want to make sure that everyone is continually giving their feedback. And yeah, we would love to hear what you guys think about this as well.
Yeah, and just to clarify that GLP thing once again, the only thing that we put out was, would you be interested in the GLP if we launched it? Would you put your tokens in? We did not formally launch it, nor ask anyone to commit to it. Anyone that's put money into the loot box, they will get their prizes, and should they be given any tokens, they will be given those tokens at the time of TG at the launch price, because again, we never committed to the launch price to make sure that in the worst situation, we never ended up in a place where we baited and switched everyone. So I would really appreciate the lack of bait and switch language, because we didn't switch.
Yeah, I don't.
Bait.
Yeah, I don't think that's the case at all. I think, guys, it's also very important to take note that in the ideal situation, we would want to do all of these things, right? If if not just markets, but the deepen industry, if everything was looking positive, we would love to do as many instances as possible to make sure that the community is really happy with this launch. But that's not the situation right now. And
Yeah,
we
we're
need to make sure
literally
that we're
saying
cognizant of that.
we're not. The GLP would be saying, "Please give us money." We're literally saying the opposite, saying, "Do not give us money." So, like, all right, next question.
So there was this question about the staking allocation. Basically, the incentive pool had 30% allocated for the staking incentives. Is that number fixed? Can it be changed? Like, how is that also dynamic, basically?
We are starting off with a 30%. This is, of course, going to be reevaluated at the right time in terms of how much of stake interest is there as we introduce new concepts down the road of staking mechanisms. But to start off with, it's a 30% pool. It can go up, it can go down, depending upon the market conditions.
And of course, we would appreciate everyone's input on it, right? The principle of this pool is it is going to be used for the community. The 30% and 70% that's being questioned is, should 30% go to reward existing hotspot owners and 70% used to incentivize new hotspot owners? Should it be more balanced? Should it be more tilted? We're going to have to try experiments on both sides of that and see how that plays out. Because any judgment on the number is wrong, and you got to start somewhere. And incentivizing growth is always numero uno priority.
Odie wanted to know, is the HO discount for DBT purchases going to be perpetual? I'm not sure what he means by HO, but I'm assuming he refers to being purchased
Hotspot
with
owners.
DBT
Hotspot
hotspots.
owners.
Oh, hotspot owners. Got it. So yeah, his question was, will the hotspot owner discount for DBT purchases be perpetual? So that might be different from what I'm thinking.
Okay. No, I would love. I would. No, it's not going to be perpetual. It depends upon, as it can't be perpetual. So for the foreseeable future, yes, it's going to be aligned. But as the network grows, what are the dynamics from 12 months from today? We will always be reevaluating as the DAO forms, at the structure governance come in. It would be for the DAO to take that decision. But for now, as far as I see, it's not going to be perpetual, because as the bandwidth consumption grows, as Karam mentioned earlier, the core utility remains the bandwidth usage. So it's going to be eventually DBT would be purely used for that. So to answer your specific question, as far as I foresee, it's not going to be perpetual, but for foreseeable future, yes, DBT would be giving a better, return in terms of owning a new hotspot.
Also, the exact circulating supply was asked by the crypto Swede. I think 10 billion was thought, but I'm not 100% sure on that one.
Circulating supply
Sorry,
launch
what's
is
that?
10 billion. No, that's
What's
what
the
is
exact
launch
circulating supply, launch circulating supply?
That can vary between anywhere between 2 to 7%, depending upon the eventual option we go for. If we were to go with option B, which is start with DEXs and eventually opportunistically unlock sexes, we are starting off with a circulating supply of roughly around 2%. And month on month, that will increase because there is a unlock that happens from the pre-sale that we did. So roughly around 10%, which is 0.293% gets unlocked every month, apart from the Genesis rewards and the daily epoch rewards. So to start with, it would be roughly around 2% in terms of circulating supply, will increase by roughly around 1% a month on month.
Yeah, and in the GitHub tomorrow, day after types, we'll put the more clear breakdown with pretty charts and graphs as well. And also, I just want to highlight the level of transparency that we're showing here. Number one, on A, exactly how the dollar of revenue flows through things, and B, also, I assume you're going to laugh at this one, but go ask a crypto founder what rates they've negotiated with exchanges and see if you get any good answers. I think the fact that we're even giving ranges and that sort of thing is like an insane level of transparency that we're sticking our necks out on this one for sure. Underappreciated fact that I just wanted to point out for historical record purposes.
Andrew MD would like to know, will all addresses owned by the foundation which own DBT be publicized and be transparent? I assume so, because we live on the blockchain.
100%. Yes, absolutely. Every single wallet related to Team Foundation, etc., will be available publicly.
Non-negotiable, yeah.
Yeah. I mean, we're posting actual customer bill payments to the chain as well. So we're committed to this to the end. This is the most build in public I've seen in my life. I never thought I would be a build in public at this level type person, but here we are. I would argue the counter. If anyone can give me a metric that we have missed putting online, I'm happy to throw that one in there.
Yeah, I feel like this is, over the last year has been an exercise in whack-a-mole of, oh, you're not being transparent, and then us coming back and saying, what do you mean? And then just like really exposing how the entire business operates. But yeah, I think end of the day, there will be, there will be some things that people might not be happy with. There are some things that people wish could be better. And that's something we've always strived to improve. I think time is testimony to that. Over the last 2 years, the work that we've done and how we've engaged with the community also speaks to that as well. Elandula is also, just to speak to your comment, I see Elandula is getting a little frustrated. It's like, there's so many questions, but, these town halls are not able to voice those questions. Yeah, I mean, that just shows how we've grown, right? We're not in the early days of having 10 people on these calls where we can get everyone on these calls and, unfortunately have like 3 hour long conversations. It's not feasible. That being said, we do still make sure that we answer all your questions and we make sure to, reply to you guys. I think you guys can see that in the chats. We don't mute anyone. We don't shy away from anyone's suggestions or comments. I think that's really, really important. I think it's also important to note just, everything that, that we've spoken about today is really a reflection over the last, couple of months since we talked about in December saying that, hey guys, we had the foresight to say that, markets are not doing great. We need to make sure that we build something that can stand through trying times, which is what we're seeing. Again, network and the people who support the network is important, and those are the decisions that are being made. So I think we're coming up on the top of the hour, unless there are any other questions that we have not answered. Dingus, Ankur, anything that is standing out that we haven't gotten to?
One thing standing out in my mind, yeah, let's see, OD615 said, so will hotspot owners have the ability to use Genesis rewards to purchase additional hotspots with DBT at TGE, or vesting schedule still applies? I think my question is, will hotspot owners still be able to recoup in a liquidity sense their investment by injecting DBT rather than selling DBT on the open market? Is there a plan to have the hotspot owners be a part of the initial liquidity? That's just from me, honestly.
Honestly, the idea of that was the Genesis liquidity program. And the expectation was there would be a market on a DEX or Launchpad or another option like that, because there was a level of enthusiasm for Deepin 8 months ago and the markets were different. Today, not yet. At the time of launch, is there going to be an immediate avenue of liquidity if you wanted to sell your tokens? No, it would have to be on the open market. And we want to provide the best platform for that. I know that's rough to hear. It sucks, but this is what the market is, and it doesn't benefit us from shying away from that. The only thing worth saying, and at least what we're focused on, is to continue building the core business, the core revenue, and it seems impossible that the market will ignore a good project with solid revenue, solid fundamentals over a long period of time. And so while there is some further pain ahead this year, we believe that the market will recognize a good project. As far as we know, historically in traditional markets and other markets, the market can be rational, but the reason that it exists is it does tend to price things correctly. And if it doesn't price us correctly, it is giving us feedback that we need to improve and adapt. So.
All right. Thank you. I appreciate that answer, Karam.
All right. So I think we're pretty much at the top of the hour. Quick summary again for everyone, just to kind of center back to what we're getting at. Still on track for launch this month. Nothing has changed. We're very clear on, this is the kind of option B makes the most sense, especially with the work that Shubs and Karam has put in over the last couple of months. Like I said, just talking to everyone across the ecosystem, seeing what is going on, making sure that the long-term interest of the project and the community is at heart. That has been the best option that we can see. Over the next couple of days, we want you guys to open up those discussions, talk about what you guys think about this. We want to hear those discussions and see what you guys think about it, everything that was discussed on this call. As usual, within the next 24 hours, a summary will go up of the town hall. It'll go up on Gitbook. It'll go up as a summary on Discord, and you will have a recording of the town hall as well, right? So as always, guys, we check all the boxes to make sure everyone is informed. That's very important. So make sure you get your comments in, put in your feedback. Once we go through, all the feedback, we're planning to have another town hall super soon. We'll try to have it within a week. That's the aim that we're going for, but let's see what the feedback is we get from this. And yeah, everything is on track and we're good to go. This is, the next, like the guy said, over the next, 6 to 12 months, or who knows, the way the markets are going, we need to be careful with how we do things, and we need to reinvent some of the things that need to be done, right? A lot of projects have done things a certain way over the last couple of years, hasn't panned out really well for them. We need to change how certain things are done. That's going to be really important. So yes, thank you everyone for joining this call. As always, we appreciate everyone's feedback. Keep the feedback coming in on the Discord with the questions on the different channels. You can leave questions on Discord. You can raise a private ticket if you want, or you can book a call with the team. All these channels are open for everyone to get in touch. Thank you again for everyone who's joining in. And yeah, we'll see you guys in the next one. Stay safe and stay happy.